Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. We're talking about the market outlook for the rest of 2025 and the importance of investing in high-quality stocks. And Nancy manages the Laffer Tengler Equity Income ETF, ticker symbol TGLR, which has been outperforming the broader market since its inception. And this year, too, it has done very well, up more than 21%. Nancy, welcome back. Great to have you with us today.
Thank you so much, Nina. It's good to be back.
So this has been an incredible year for the stock market overall. The S&P 500 is up about 16% year to date. So we could be looking at the third consecutive year of 20% plus gains. But lately, some doubts have started to creep in about the strength of the tech-led rally and sustainability of the AI trade. So we'll get into the broader markets in a moment, but I wanted to start with tech earnings because last week was big for these big tech earnings. 5 out of the 7 Max 7 stocks reported, and those results show that the AI story still has plenty of momentum, but now investors are asking questions whether those massive investments will start delivering some returns, meaningful returns. So tell us about your key takeaways from tech earnings.
Yeah, well, thank you for that setup, Nina. It's been a remarkable earnings season, and yet we haven't necessarily seen that follow through with the stocks, and that's very reminiscent of the summer of 2022, right before we began this current bull market. You saw these companies delivering 20, 25%, 18% earnings and revenue growth, and they weren't being rewarded in the marketplace. And so as an investor, I have to step away from some of the day-to-day noise that is driven by the algorithms, and then the hedge funds jump in. And I have to look at the company and say, do I want to own more of this stock for the next 3 to 5 years? And if I look at tech earnings, so Amazon is in our 12 best ideas portfolio. Microsoft is in our 12 best ideas portfolio. Google is a major holding in our equity income and our growth strategy. And so it's important to me to really understand the underlying, not just earnings power, but revenue growth power. And if you look at the total RPOs, so remaining performance obligations at these companies, they're great. They're greater than $1 trillion. And that was announced, cumulatively from all the earnings calls. So that tells us that the demand is there. And then if you look at the commitments to CapEx, what we heard from the CFO of Microsoft, Amy Hood, we're not going to increase CapEx faster than revenues. You heard from Amazon that it's not a demand problem, it's a supply problem. And so all of those anecdotal comments and takeaways tell you that we're probably, and I believe this, still in the early stages of the AI trade. And there are a lot of naysayers, and that's often the case. It was also the case in the 90s when we were in the early stages of the internet boom. But my calloused response to all of that is that most of the bears, I think, are the people that got out in March and April due to the tariff tantrum in the stock market, and they forgot to get back in, because these companies they're not toys.com or pets.com. They are companies that have multiple business lines, fortress balance sheets, and cash flow generation that is the envy of some countries.
So earlier this week, some of these AI darlings came under pressure after we learned that hedge fund manager Michael Burry, who famously predicted and shorted the subprime mortgage bubble, He's shorting Palantir and NVDA. And lately, there have also been some concerns about the sector's heavy dependence on one company, OpenAI. And they have signed these huge multi-year deals with NVIDIA, Oracle, AMD, Broadcom. And these deals are reportedly worth about $1.5 trillion. So I was interested in your thoughts about the trade being in bubble territory and also dependence on one particular company.
I think OpenAI is really trying to continue the first mover advantage, and they've strayed from the mission most markedly, and they're trying to book all these deals. So you don't just have the deal with AMD and the deal with Oracle that they have to fund. You also have the deal with Walmart and the deal with, I think it was Etsy. And, you've got this foray into erotica, which I just find kind of disgusting. But so it's a company that is trying to wrap everyone up in its ecosystem. But I would say that that'll work its way out. I mean, there will be folks willing to fund that. We saw Masasan step in there, and we've seen others clearly. But I think what you want to watch is a company like NVIDIA that continues to drive earnings growth. So if you just look at like calendar year numbers, this 2026, the company's expected to grow at 46%, 21% in 2027, and 15%. But in just using 2026, if it's growing at 46% and the PE multiple on that is 42 times, then it's trading at a price earnings to growth ratio below 1. That's a very different scenario than Palantir or Tesla, for that matter, that are narrative companies. People buy them based on the narrative, not necessarily the valuation. But they're narrative companies that are not going to be valued like a normal company. But NVIDIA is a company that has generated earnings growth for quite some time, and it's not expensive. So he can short NVIDIA all he wants, but this is not a company that's trading at a lofty multiple compared to earnings growth. And I think that's the question that investors have to ask themselves. Now, Palantir, different story. I mean, we saw the earnings. They came in they were showing growth of 123% in one of the business lines. That's compelling. And those are reminiscent of Amazon, after it went public in the 1990s. There were years I didn't get it. I was like, why is this company going up? There's no earnings, lots of growth, but no earnings growth. And that was a lesson for me as a value investor to say, sometimes the narrative matters. And I think with Palantir and Tesla, for example, the narrative does matter. And that won't stop the hedge funds from taking shots at them, for sure.
Right. So it seems that if you were to put fresh money to work now, you still like companies, high quality companies like among tech companies like NVIDIA, and you mentioned Google, Amazon, Microsoft, and you would avoid companies like Palantir and Tesla?
We do not own either of those in TGLR because we require a dividend and dividend growth in TGLR. But we do have a growth strategy that focuses on some of those names. And I would say, no, you on weakness, we added to both those names during the tariff tantrum. So we picked off NVIDIA around $100 a share, and we picked off Tesla at 240. The naysayers were just as loud back then. And so as an investor, you have to keep asking the question, is the vision real? Is the leadership solid? Is the valuation out of whack? And if so, how much can it tolerate, in terms of pressure? And they'll get whacked by the hedge funds shorting them. But that's usually an opportunity if you believe in the vision, as we do.
Right. Very interesting. Now, going back to the broader market, I saw your note where you mentioned that we may be due for a sustained correction, but it will be just that, a correction. So could you please expand on that and maybe tell us where you see stocks heading by the end of this year and beyond?
Yeah, so a correction is somewhere between 10 and 20%. And we had one of the major houses come out, and that started the sell off on Monday. And they said, stocks are due for a correction of about 10% over the next 12 to 24 months. Well, that's like stating the obvious, because we get a correction about once every 12 months. And so on average. So for me, a correction is an opportunity, and it should be for any long-term investor that is interested in buying stocks at cheaper than they were pre-correction. And so we would use that as an opportunity, just as we did in March and April, to add to names that we want to own for the next 3 to 5 years. And I think from here, we are due for a correction, because we ran really hard upward after the tariff tantrum. And so if we get a pullback, I will be in buying. And then I do think we end the year higher than current levels. And I don't know if it's 5%, maybe close to 10. But the point is, earnings season has been remarkable. That's backward looking, but guidance has been really good, and that's forward looking. So we want to own these companies for the next at least 2 to 3 years.
Now let's talk about the state of the U.S. consumer. And earnings reports from some of the consumer companies are now increasingly showing a K-shaped economy. So wealthier Americans are spending more, their stock portfolio is going up, their house values are going up, and lower income Americans are paring back. And in fact, lower income consumers have been paring back for the last couple of years. And now it appears that even middle income households are cutting back on spending. At least that is what we saw from comments made during earnings calls of Chipotle, Kava, Shake Shack, and other companies. So
Yes.
Tell us about your thoughts on the state of the US consumers and which companies are poised to benefit.
Yes. So we heard from Ralph Lauren today that they haven't seen any change in the consumer. So that goes to your point that the well-heeled consumer is still spending. But happily, we don't own any of the three that you named. We used to own Chipotle, and we just thought management was not rising to the occasion. So we sold it around 40, and the stock has really tumbled. But I think McDonald's, which is the stock we own in TGLR, showed us that, same store comps grew. They were seeing more spending from customers that were coming in, but they were seeing fewer customers coming through the doors. That said, they beat on earnings and I believe on revenues, but I'm not 100% sure about that. And so I think you have to do it company. You have to step back and look company by company, and there are companies that will continue to benefit, like TJX or McDonald's, that are catering to the lower end consumer. But I would say this, Nina. I think McDonald's they pivoted. They brought back the value meal. They have been advertising price. Chipotle didn't pivot. And that's reminiscent to me of the transition that Walmart made, attracting higher income consumers when we were facing very high levels of inflation just a few years ago. And Target just missed the boat entirely. And so I think that's what you want to look for, is management teams that are embracing the new technologies and the new trends. And the new trends are price sensitivity for a big chunk of consumers. Now, that final thing I'll say is that the net worth of the American consumer is still $176 trillion. And that's up from the last reading, but it's mostly more than half of that is housed among the baby boomers. So again, the well-heeled investor. And, we've seen a lot of layoffs, almost 1 million year to date. So we're watching it. Because consumer is 2/3 of the economy, consumer spending. So we're certainly watching it, and we're very picky about which of the the fast casual dining restaurants we want to own, or fast food, and same with retail.
Yeah, Walmart has been very interesting in how they won over wealthy shoppers. That's been remarkable. You do own some big banks also in the portfolio, in the TGLR portfolio. I saw that JP Morgan, Goldman Sachs, and these have done really well this year because there's been a surge in deal making activity, and we have seen resilient corporate spending as well. You also own American Express, and I was looking at the performance of these stocks. So Goldman Sachs is up almost 40%, more than 40% this year, and JP Morgan 32%, American Express 25%, and these have vastly outperformed the broader financial sector ETF, which is up just about less than 10%, and the regional bank ETF is actually flat for the year. So I was interested in your thoughts on financials in general. Do you stick with these best in business big banks only going forward as well?
Yeah, it's a great question, Nina. I mean, I keep asking myself, should we be adding regional banks in? But then we step back because the fundamentals are just better for the big banks, and especially those that have the M&A aspect and the trading aspect. And I don't have the numbers at the tip of my tongue, but I mean, we know that Goldman Sachs is about half non-interest income, plus or minus, and the same for JP Morgan. That's kind of where I want to be positioned here while we're still trying to figure out where interest rates are going to go, because we've seen the Fed cut multiple times, but rates have either gone up or stayed up where they were. And so this is a difficult environment for regional banks. Now, deregulation that we see coming will help for sure. But we're really more focused on Brookfield Asset Management, which is a non-traditional lender, American Express, that's I think our largest holding in TGLR in the financial space, and then Goldman and JP Morgan. We're going to stick with that trade for now, all the while continuing to ask the question.
Tell us a little bit more about the investment process for TGLR. So it is an actively managed portfolio, and it's a concentrated portfolio, about 33 stocks, large cap stocks. And these are the stocks that you consider to be high quality. And you also look at dividend yields. So tell us more about your selection process and weighting.
Thank you for asking that. So what we utilize as our valuation metric is relative dividend yield, which was developed by, we used to call them bosses, but I think now we call them mentors in the 1980s. And we've refined it over the years. But what you get from dividend policy in these large companies is you get management teams that are setting the dividend based on what they think long-term sustainable earnings power is. So this is not a strategy that buys the highest yielding names. It's a total return strategy that's focused on dividend growth, because dividend growth tells us what the management thinks about future earnings growth. It's not quite that simplistic, but almost. And so we graph the relative yield, and we get these periods of underperformance and outperformance, but very long cycles. So great example is we were buying Apple in 2013 when the yield was 3%. It was above the 10-year. They had not paid a dividend, for most of their history. But that was a time when it made sense to us if looking at the relative yield and looking at the underlying business, because we do our own proprietary research. We sit on all the earnings calls. I mean, we're an old school asset manager in that regard, but we are disciplined. And so if you look at that company, we didn't really start selling it until 2022 or 2023, sorry. And so that's a very long holding period. And that's what relative yield brings you. It brings you these companies when they're out of favor. And then we have a research approach called the 12 fundamental factors that I developed in the late 1990s. And we've enhanced it, of course, but that's something that we write up on every company we own, every company we want to own. And then we reassess it when companies are under stress to see if we should exit, because that's the value manager's biggest risk, is owning what we call terminally cheap companies. So we do the work, we do the proprietary research. We have a team that supports me on the strategy, and that's what we're always looking for. What are we missing? What's the catalyst for outperformance? Is there a catalyst? And that's our focus. So and then we believe that if you have conviction about a company enough to own it, you should own a meaningful amount. So our minimum position is 2%, and our largest position is we buy to 5%, and then we trim it as it appreciates.
Awesome. Now, switching gears a little bit, I know that you're very passionate about helping people learn how to save and invest, and particularly women. And you also wrote this book, The Women's Guide to Successful Investing. Tell us a little bit about the book and why this topic means so much to you.
Thank you. It's close to my heart. So I meet a lot of women, and either as potential clients or just, as I travel around the country. And most women excuse themselves from the conversation around investing. And it's just been part of our culture. They defer to the money spouse. In a traditional marriage, the money spouse is usually the man. And that becomes the sort of the rhythm of the relationship. But the average age of a widow is 59 and a half in the United States, or 59. And the average age of a woman's first divorce is 30. So if you go into a marriage and you just defer all those decisions, you're not very well prepared when you need to be the most. I was 59 when I was widowed, and happily, I guess I was already managing the money, but there's so much to do and think about, and you're grieving, that the last thing you want to do is learn how to invest to your list of daily activities. The research, here's the amazing part, Nina. The research shows that women make better investors than men. And that's empirical research. It's not anecdotal. There were studies that have been done that show that women do more research, they're less competitive, and so they invest for the long term, and they generate, depending on the study, anywhere from 1% to 5% annually more than their male counterparts. And that compounds and is meaningful money over time. So I just want to give women the language and the tools to say, I can do this, because a lot of the attributes that we use in running a household or, shopping for items for the family, those are the same traits that are required in investing. It's research, it's knowing the product, it's understanding the client service model, whatever the product is. And so that's my goal, is to empower women to participate in the process if they are married, or while they're single.
Awesome. I really appreciate your advocacy and the work that you're doing. And we'll have to leave it there, but excellent stuff as always. Thank you so much for joining us today and for sharing your insights.
Thank you, Nina. It's great to be here.
That was Nancy Tengler. Now, let's quickly recap some of the tickers that we talked about. So the ETF is TGLR. We talked about some of the top holdings in this ETF, and we also talked about NVDA, which everyone knows the ticker symbol is NVDA. We mentioned Microsoft, ticker symbol is MSFT. Google, Alphabet, the ticker symbol is GOOGL. Oracle, the ticker symbol is ORCL. She talked about Walmart, where the ticker symbol is WMT. American Express, AXP. We also discussed JP Morgan and Goldman Sachs, JPM, and GS. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.